Good afternoon, this is Sean Golden with Golding & Golding, here to go through the basics of Puerto Rico Incentives Code 60, otherwise known as PR Act 60, which is a combination of prior Acts 20 and 22, individual and corporate, as well as other acts under the Incentives Code. There's a general misunderstanding out there in the World Wide Web based on bad information that you pick up, you move to Puerto Rico, and suddenly you're living tax-free. Obviously, that's not how it works, right? So you got to be careful. A lot of sales pitches online. Attorneys trying to make you think it's real simple. Pay them a bunch of money, and they're going to get you to Puerto Rico. You're not going to pay any tax. So basically, from a baseline perspective, PR, it's a commonwealth, right? You have places like Guam, other areas in which it's not technically considered a state, so the tax rules are a little bit different. For example, if someone is a bona fide resident of Puerto Rico, they generally don't have to file a U.S. tax return unless they have U.S. sourced income, et cetera, et cetera. So for some people, it can be a great benefit. Generally, forgetting Act or Incentives Code 60, just generally qualifying as a bona fide resident, having all of your income in Puerto Rico, good way to go. It gets way more complicated when you're trying to meet Incentives Code 60. And basically what that is you have to apply. It's sort of kind of like a golden visa program, right? There's citizenship by investment, resident by investment. With these different programs, something like St. Kitts, if you're looking for citizenship, Portugal, if you're looking for residence, you pay a gang of money, and then you get certain rights. You could become a citizen or a resident, and then that is one step in the direction of expatriating, giving up your U.S. citizenship. The nice thing about Puerto Rico is you don't have to do that. You don't have to formally expatriate in order to become a resident of Puerto Rico under Incentives Code 60. But there are, like with most golden visa programs, for example, they start out relatively simple, and then they get more complicated or expensive as time goes on, and they become more popular. With Portugal, they're changing it this year. It used to be, you could invest in a property in Lisbon, you've got no issues, and now you got to go 50 miles out to the rural country, which may be something you want to do, but not a primary reason why a lot of former U.S. citizens end up making their way out there. It requires approval, a lot of fees up front. Now you have to purchase a property within 2 years, I believe it is, and it can be expensive, right? You have to be a bona fide resident, so you can't just be there for a week or two. It's got to be your home, and so you're investing some real money in it. Here are some of the common tax issues to consider before just picking it up and hightailing it because some attorney told you should do so. One, okay, there's this whole thing about zero capital gains tax, but it's not that simple, okay? If you go under, we'll just call it Act 60, because Incentives Code 60 takes too long to say, right? If you're going under Act 60, any previous capital gains that you had where you have unrecognized gain, you can't just go there and sell it. You get a lot of inquiries with cryptocurrency, right? I bought it for, $100, now it's worth $1 zillion, and I want to go over there and sell it and not pay any capital gain. It doesn't work that way. Now, gains that you may derive from newly purchased stock after being accepted is different, but you can't just take your unrecognized gain, shoot over to Puerto Rico, and then sell it for no tax, which is a main reason why people consider going in the first place, because they have this bent up gain, unrealized or unrecognized gain that they haven't actually realized yet. They haven't sold the stock yet, and so they think if they go to Puerto Rico under Incentives or Act 60, they can do it, but you can't, right? And they're very strict about that. In order to not be taxed on income, it has to be sourced in Puerto Rico. And the only income that's not taxable would be U.S. So let me give you an example. A U.S. person relocates to Puerto Rico, and they decide, you know what? I got a ton of interest in dividends from, $15 million worth of money that I have outside of the United States. I'm out of the U.S., it means that's it, right? Wipe your hands of it. You don't have to pay any U.S. tax. But that's obviously not how it works. You're still taxed on your worldwide income if you're a U.S. person, no matter where you live. So the mere fact that you live in Puerto Rico and you're deriving income from sources outside of the United States, you still have to pay tax on that. in addition, and this is where it gets complicated. Puerto Rico is still considered a Commonwealth, right? So you still have to file the FBAR and FATCA FBAR for sure, because as a U.S. person, you would have to file it. FATCA, Form 8938, is filed along with your U.S. tax return. So if you don't have to file a U.S. tax return, presumably you wouldn't have to file the 8938, but most people fall into the FBAR category. And so, excuse me, even though they may not have to pay U.S. tax, they still have to report everything. And a lot of the reasons people go over to Puerto Rico, right, is to avoid being under the IRS's radar. If you're considering moving to Puerto Rico and you're not in compliance in the U.S., you want to consider getting into compliance first. There's lots of programs that are available to taxpayers, depending on whether they're willful or non-willful. We have lots of free information on our website. You can always reach out and schedule a reduced fee consultation. And please stay aware of attorneys and others just trying to sell you on moving to Puerto Rico with a 0% tax rate. That's generally not how it goes. Thank you for your time. Enjoy the rest of your day.